Okay, so thank you very much for joining our weekly webinar, and we're excited to see you all here and start trading with OneRoyal Broker. A quick disclaimer, the information provided in this webinar is for educational purposes only. It's not considered as a financial advice. Please do your own research before start trading. So our topic today is understanding candlestick charts. So we have these chapters or points that we will cover. We have candlesticks versus bar charts, candlestick components, how to interpret candles and candlestick patterns, the most common one. We will talk about them, and then we will go to MT4 to show you real examples. So the most common chart patterns are the candlestick and the bar chart. Candlestick chart is the most used one. So first we have here the bar chart. As you can see, this is how it is composed, and this is the candlestick chart. So this is the difference. We use the same asset on the same period of time, and you can see the difference between the bar chart and the candlestick chart. So if I want to give you the main difference, let me write here, 1 second. So the bar charts are made from bars similar to this. You will see them if you zoom in on the chart. This is the opening here, and this is the close here. We'll talk about this in details in the candlestick chart. The bar chart are made from candlesticks with a form like this. So this is the bar. This is called a bar. This is called a candlestick, Japanese candlestick. So which one are better? There is no one better than the other. However, the main advantage of the candlestick chart, which is this one, it's more visual than the bar chart. Okay, you will see that it is easier to spot patterns using the candlestick chart. However, for those who are more into indicators, they prefer the bar chart. However, the naked price action traders use this type of chart, which is candlestick chart, because it gives them more information than the bar chart. They can find more info by just relying on the candlesticks itself. Okay, if you use indicators, I think this much better than the candlestick chart. So what are the components of the candlestick chart or candlestick bar? So we will focus more on the candlestick chart because they are the most common ones. So as I drew before, this is the form of a bar. It has a high, close, open, and low. Okay, it's called HLOC as well, HLOC. You can see it at the top of any chart on a platform. So these are called the wicks. Okay, so I will make this more cleaner. Let me remove everything from here. So this bar chart is made of a body. This is a body. This is called a wick, similar to here. Some of them, they call it as a shadow or a tail. So it has three names: shadow, wick, and a tail. The colorful part here, it's not that colorful here because we have white and black, but usually you will see them green and red. But the big part here is called body. In case the close of the price is above the opening price, we call it as bullish we call it as bullish bar. This is a bullish bar since the closing price is above the opening price. However, if the closing price is below the opening price, we call it as bearish bar. So if I give you an example how this is formed, let's say this is the opening of the bar. And during the day, if we are on the daily time frame, the price of an asset fluctuates, as you know. So it goes up, down, and then if it closes above at the end of the day or after 24 hours, if it closes above the opening, then we will get a bullish bar similar to this one. Okay, and the opposite if is true as well. So if we have the opening here and then during the day the market fluctuates up and down, but the sellers manage to push it down, and then close it here, then we will have a bearish bar. Okay, the bearish bar, it will be black, red, it depends on the parameters that you're using on your platform. So a bearish bar similar to this one indicates that the sellers are in control. There is a high sell pressure. However, on a bullish bar, it shows that the buyers are in control or overwhelming the sellers. And this shows that most probably the market might continue to go up. Okay, this is a bullish candlestick. So we'll talk about this here in detail. So we have, as we said, the OHLC on each candlestick, high, open, close, low. The end of the tail, it is the lowest price recorded during the day. If we're talking about a daily time frame, if we have a 5-minute time frame, this is the lowest price recorded during the 5-minute bar. This is the highest price, and similarly here, highest price and lowest price during the time frame you're using. Open, close, open, close. So if we look here, if we have a big body and it is bullish, that means the close is above the opening. This shows that there are a lot of buyers, or we call it very bullish. This one shows that it is less bullish since the body is smaller than this previous one. So close here, open here. Okay, so the body reflects or give us a lot of information about if the buyers are pushing the sellers to the upside or pushing the price to the upside, or if we have a lot of buyers. If the body is big, that means we have a lot of buyers or high buy pressure. However, here the opposite, if the bearish body of the bar, next this is here, if we have a big body as a bearish bar, this shows that there are a lot of sellers. That means the price closed here, open, so the seller managed to push it down, and then close it much lower than the opening. Okay, so this is why it is very bearish. And the smaller the body, that means the sellers are less and less and less. How to interpret the candles using them as a combination, or if you see a candlestick chart, how you come up with, let's say, a trading idea, or make an analysis based on just candlesticks. So by looking on this chart here, this tells us a lot of information. Since the market is moving to the upside, where we have higher highs and higher lows, this shows that the market is in a clear uptrend. So let me explain a little bit about the high and the higher highs. So this is a swing high, we call it, or simply high. Here the market managed to move to the upside, so the buyers are in control of the market. You can see we have big bullish bars, which is a good indication that the market is moving to the upside. You can see big bodies here, big bodies. So this is a good indication that the buyers are in control, or the bulls. And since the market is moving to the upside and posting higher highs, so if this is a high, this is called a higher high, that shows that the momentum is positive. The price is in an uptrend. Also, you can look at the lows. So if this is a low here and the market is moving to the upside, this we call it as higher low. So in an uptrend, you should look for higher highs and higher lows. And another thing that you should look at is the bullish bars. If they have big bodies, that means the market is moving to the upside, similar to these three examples. One more thing that I would like to talk about an uptrend, or the health of an uptrend. If the market is respecting the trend line, so here we have a trend line. We drew a trend line using the lows here. So this is a trend line. So if the market is respecting this trend line, this shows that we have an uptrend and everything is going to the upside after it. Most probably. We always say most probably. Okay, so three things to look at in an uptrend: higher highs, the bodies, the big bullish bodies, and higher lows, plus we call this as a bullish trend line. This is a bullish trend line. Similarly, but to the downtrend, we have different keywords, but same concept. So if this is a high, this is called a lower high. So the market is moving to the downside. This is a low, this is a lower low, okay? So if we look at the bars, this is how we can know that we are in a downtrend and there are a lot of sellers. We have big bodies here, big bearish bodies, okay? So the big bearish bodies are appearing on this downtrend. This shows that the sellers are in control of the market. However, if you look at the bullish ones, they are small ones. Okay, but the bearish one, they have big bodies, and this shows a high sell pressure. We have a bearish trend line that is respected. You can see it that the market every time approach this trend line, it will drop to the downside. This is another indication to know that you are in a downtrend. Another thing that you should look at, as I said, are the lower high and the lower low. In the previous example, we had higher high and higher low. Here we have lower high and lower low. So if this is a low, this is a lower low, high, lower high. And you can see that these highs are far from each other, which is a very good indication that the downtrend is healthy, we say. Next, I will talk about candlestick patterns. We have the three common ones here. We'll start with this. We have the three black crows or three white soldiers. We have bullish engulfing pattern or the bearish engulfing pattern. And at the end, we have the hammer and the shooting star. All of them, the three of them, okay, shows a reversal. And what I will do is I will go to the MT4 to show you a real live example. Okay, so this one, I consider this as one category, this one category, and this is another category. But all of them, each one of them, they show a reversal. Let me go to MT4 to tell you what I am talking about. So first, we're talking about the engulfing bullish pattern. So an engulfing bullish pattern, it is this one here. It is made of 2 bars, you can see that this big bullish pattern engulfed the previous one. This shows a reversal. The market is moving to the downside. After it, we can see that the market moved to the upside. So whenever you have a bullish engulfing pattern, it is made by 2 bars. One has a big body, a bullish body, and the previous one has a small bearish body. If the first one, which is to the right, is much bigger than the previous one, we call this as engulfing bullish pattern. This same pattern, you can see it in the top of a trend, which is here. We have the bearish body here, the big one, and the previous one is a small bullish body bar. Okay, so if this one engulfed the previous one, and it should be much bigger than the previous one, we call this as a bearish engulfing pattern. And usually it reverses the trend from an upward movement to a downward one. So you can see that the market was moving to the upside. We have higher highs and higher lows. Then the market posted a bearish engulfing pattern. You can see that the bearish bar is much bigger than the bullish one if we look at the body, and then we have a reversal. The market move to the downside. Another thing that I will talk about is the hammer. The hammer is a single bar that is found at the bottom of a downtrend. So we have here a downtrend, lower high, lower low, lower high, lower low, and then we have, this is here highlighted, this is the form of a hammer. It is made by 1 bar that has a long wick to the downside and a small body to the upside. So if you see this bar at the bottom of a downtrend, most probably we will see a retracement or a reversal. Here we have a small retracement to the upside. This is not a reversal. It's a kind of a correction like this, and then the market tumbled again. But this correction, it's huge, because if we take this from here to here, we have at least 107 pips. So you can benefit from this move to the upside. Usually these patterns are not used alone. You will use it with support and resistance and maybe in another indicator. But if we're talking about this pattern or this indicator, it shows reversal from a downward movement to an upward one. It has a small body to the upside and a long wick to the downside. A shooting star is the opposite. It will have a long wick to the upside and a small body. So if we look at this one here, this is kind of a shooting star. The single bar, okay, you will look for a single bar. It has a long wick to the upside and a small body to the downside. So as you can see, the market moved to the upside here and then reversed all the way down. So the long wick to the upside and the small body to the downside, it reversed this movement from here till down. So you will find it at the top of a retracement or a top of a uptrend. It reversed the market from an upward movement to a downward one. We'll talk about the 3 black crowds and the 3 white soldiers. The 3 white soldiers indicate a continuation of the upward movement or a move to the upside. An example of this, so if the market is moving here to the downside and started to move to the upside, these 3 bars here are called as 3 white soldiers. 1, 2, 3. Usually they have 3 bullish bars that they are closing above the close. So we have a close above the closing of the previous one. Here, this is the close above this one, and this the close above the previous one here. So they are closing above the previous closes. So we have, this is a 3 white soldiers, and they come in this pattern like this, and this indicates that the market will continue its move to the upside. It is a bullish pattern. However, the 3 black crowds, it's totally the opposite. It shows a continuation to the downside, and here we have a lot of them. Examples I can give you is here. you can see we have 3 black bars where each close is closing below the previous one. Okay, and this shows that the market is so bearish, and you can see that we have a continuation to the downside. Okay, and this is another one here if we look as well. 1, 2, 3, and then the market dropped aggressively to the downside after it. So this is the 3 black crowds. So we have talked about the main common patterns and show you a live example. This is it for our weekly educational video. If you have any question, please drop it in the live chat so I can respond to your questions. Okay, it seems nobody has any questions, so we will end the webinar. Thanks again for joining, and see you next week.